Coming up in today's review, stocks finished the day higher, on the back of higher than expected inflation, where the inflation is coming from, why the Fed's still going to cut rates anyway, and 4 areas of the market to hide out from a bubble. And so even though the Consumer Price Index, CPI, inflation data for February came in a bit hotter than expected, the growth side of the stock market didn't seem to mind at all. Actually finished up a bit higher, led by the big fella NVDA, closing up over 7%, along with the rest of the tech space, all having a good day. There was a bit of a response in the yield-sensitive sectors of utilities. We did get a bit of a bump up in bond yields, same with REITs pulling back. However, the cyclical sectors and industrials all had a good day as well, along with a bunch of hot stocks that we follow. And the march higher continues. S&P 500 just sitting a few points underneath all-time highs at 51.75. We had the growth sectors leading today, semis, tech, home builders, communications and discretionary. And apart from the Russell 2000 and utilities, all other stock sectors are in uptrends on multiple timeframes above their 5, 20, 50 and 200-day moving averages. And so this parabolic grind higher is still intact. And we've got breadth breaking out as well. Amount of stocks above the 200-day average, currently around 80%. And we've got a huge crush in volatility today. VIX closing down 9% to 13.8. And looking at 2-week seasonality ahead, it's forecast to come down even lower. And the most important stock at the market, NVDA, still pretty volatile here, which can be associated with tops and bottoms, with prices moving around a bit. And to finish the day up 7%, pretty big move for a $2.3 trillion company. Just to put that in context, that's about $160 billion change in market value today on a stock that's made $30 billion in net income over the last year. So just its change in value today is more than 5 times its trailing 12 months profit. But stick with me today because I'll come back into the charts and I'll show you what else I'm seeing out there that I think you'll find interesting. First, let's just take a look at one of the biggest influences on markets, and that's inflation numbers and expectations. So each month we get a look at Consumer Price Index, CPI data for the previous month, and headline inflation, which is an all-inclusive look at most products and services, expected to increase 3.1% year over year, actually increased 3.2%. And core inflation, which strips out food and energy, came in a bit hotter than expected as well, 3.8% year over year increase. Whilst the headline month over month came in as expected, 0.4% increase. Core inflation month over month beat as well, 0.4% increase. So this is clearly not low inflation numbers, showing that this final stretch to get down to target is not coming easy. Hit a few bumps in the road. Inflation's been flatlining for over half a year now, if not slightly turning up. And so just looking under the hood of where inflation's coming from at the moment, all items up on average 3.2% year over year. Food overall is not that bad, 2.2%. Even though food away from home still tracking pretty high there at 4.5%. Probably notice your insurance rates gone up a lot since this time last year. And other things like non-prescription drugs, auto repairs, personal care products up 6%, and shelter, still a big one, 5.8%. So core inflation still increasing near 4% year over year. Risk assets ripping to new all-time highs. Crypto mania back on board. Shipping and cargo rates ripping higher these last couple of months. The government spending at crazy records it's never done before. You wouldn't think that would be the environment to cut rates in. Just like the man who understands finance, probably better than all of us, JP Morgan CEO Jamie Dimon, is urging the Fed to show some caution and restraint when it comes to cutting rates, as they will likely pour fuel on the fire, causing a resurgence in inflation down the track. Because like bond manager Pimco says, unemployment really needs to rise for the Fed to hit its inflation target. Kind of almost impossible to hit 2% inflation with record low unemployment rate, as there's still so much consumer discretionary spend out there. And let's not forget, even though we've been getting a bit of disinflation this last year, with it coming down off those crazy peaks, a lot of the inflation we've had over the last couple of years is well embedded in prices. And if CPI had been rising at the Fed's 2% target since January 2020, the actual CPI index should be about 280 now, whereas it's actually 11% above that trend at 311. And so if the Fed really wanted to get on top of inflation, we wouldn't even be talking about rate cuts. We'd be on pause for quite some time. And even though we got a bit of a bump up in bond yields today, which we can see in the 2-year yield, only closing up a modest 5 basis points to 458. Same deal on the 10-year, just sitting at 415. It wasn't a huge rip at all. In theory, and in normal markets, this hotter than expected inflation report should keep the Fed from cutting rates anytime soon. Let's just keep in mind we don't have normal markets. We haven't for a while, and there's other big political forces at play here, with Biden already telling everyone that rates are going to come down soon, and a pretty strong signal to the Fed. And that's why the probabilities today of the Fed cutting rates didn't even change market's still assigning a 70% chance they're going to cut in June, with another cut forecast in September. Keep in mind when the Fed meets in June, July, and September, they're the last 3 Fed meetings before the US presidential election on the 5th of November, just 2 days before the Fed's November meeting. And so not only will a couple of rate cuts in the months leading up to the election help the Biden administration, more importantly, it'll help bail out the Treasury and the US federal debt, giving them the opportunity to refinance huge amount of debt at lower rates and kick the can down the road for a few more years, letting someone else to eventually have to deal with it. And just going further into the numbers, the US federal budget deficit, that's the difference between what the government spends and what they make, mostly from tax receipts, widened to $296 billion in January. That's up from $262 billion the same month last year. It's more than a 10% increase. The first 5 months of the fiscal year, deficit widened to $828 billion, up from $723 billion over the same period last year. It's about a 15% increase. And just looking at receipts in February, they were only up $9 billion to $271, while outlays rose $43 billion to $567 billion. So it's simply just an unsustainable rate of spending. A few things have to happen for that to correct over time. Either spending has to come dramatically down, taxes have to go dramatically up, or a bit of both, because the interest alone was already $127 billion higher over the first 4 months of the fiscal year than the same period a year earlier, and hence why it's important that the Fed cut rates, allowing the US government to get their interest expenses way down. And while everything is okay for now, the bond market may increasingly not like that scenario. Going forward, we're already seeing signs of stress in the Treasury auction market, with today a $39 billion of 10-year Treasuries being met with poor demand, with dealers having to step in and take more of it from the usual bidders to get it done. And that was likely the source of the rise in yields today, opposed to the hotter than CPI report, because like we can see in Fed Fund futures, the market still thinks rates are coming down in June. So even though stocks are a little stretched here all around the world, got some global equity momentum, especially in the growth areas, we're likely to see a pullback at some point before November. However, it should only be a 5-10% correction. Got a lot of good seasonality, government spending like crazy, rates supposed to come down, AI hype and momentum. The forecast is any pullback shouldn't turn into a bear market. However, if it were to go a bit more than a short-term pullback, maybe into a medium-term correction, and there were signs the potential AI bubble was letting out a lot of hot air, there could be 4 areas of the market which may offer some good diversification benefits, as highlighted by GMO co-founder Jeremy Grantham, who said for those who must own US stocks, even when they are generally overpriced, there is a reasonable choice of relatively attractive investments. And it's true, even though on a lot of measures the main indices are looking a little overcooked, underneath the hood, some pockets of the market are still offering up some reasonable value, like the quality factor. They have a long history of outperforming the stock market during bear markets, as they have a defensive nature, strong balance sheets, cash on hand, low debt. One that I've been talking about for a while now, resource stocks. They offer a lot of diversification benefits. And just like Bitcoin, they are also finite and scarce in nature. However, unlike Bitcoin, you can actually use resources to power the world instead of taking away power. You also got climate-related investments, another area I regularly talk about with clean energy stocks, also like uranium, nuclear, hydrogen, in addition to the traditional solar and wind sectors. And another area I talk about often, deep value. Small cap stocks cheap and value stocks are cheap after underperforming for over a decade now, and some of the widest spreads between growth and large caps as well. And just to show you the monthly charts of ETFs related to those 4 themes, here's the quality factor ETF under ticker QUAL, which looks to be in a healthy bull market in itself. Same with the Vanguard Value ETF, VTV. Still offering a respectable dividend yield of 2.3%. There's a lot of different ways to play the resource sector. One of them is through the metals and mining ETF, XME, and the cheapest and most beat down of them all, clean energy. Looking at one of the biggest ETFs in this sector here, the Invesco Clean Energy ETF under ticker PBW. It's got a healthy dividend yield of 4.7%, and a bit more speculative area of this sector is hydrogen and clean energy technologies as well. And just getting back into the charts, we've got the bond market tracking sideways here as a look at long-term treasuries. There's corporate grade debt and high yield bonds kind of coiling up in some sideways action here. A little bit of a bump up in the dollar today with those higher yields. There's Bitcoin still consolidating just above $70,000 a coin. Shipping and cargo rates still in a strong persistent uptrend. Those higher yields saw a little bit of a pullback in gold today, falling a bit over 1%. And there's crude holding ground at $78 a barrel. And just zooming out to the weekly chart on crude, this trend here is really what's helped inflation come down, since inflation peaked around this time as well. And so just like crude over the last half year or so, inflation has also flatlined and stalled out. And you can just imagine what would happen to inflation if we did see crude tick back up above $90 a barrel again. That would likely throw a big spanner in the works for the Fed, the Biden administration, and the US government as a whole to refinance its huge amount of debt, keep its unsustainable path of spending going. And so we shouldn't rule out more instigation of conflict from Iranian-backed militants and rebels around the Middle East, and who knows, maybe Russia and China as well. May want to upset the picture for Biden and the US as a whole. And looking at infantry in the Strategic Petroleum Reserve, that's still well off highs, which reached 726 million barrels 2010. Here we are at 360 million, similar level to the early 80s, when the population and energy usage was much lower than what it is now. So there's not much room to move in the Strategic Petroleum Reserve if oil did spike. Biden already released a heap after Russia went into Ukraine, and he was trying to counteract spike in oil prices back then. So they've actually been looking to refill that over the last year or so. And so like I always say, keep an eye on crude for an idea of upcoming inflation. And if it does spike up, you can bet the Biden administration is going to do everything they can to get it back down as quickly as possible. But it's not just crude and energy. We've also got food breaking out. We can see that in the agricultural ETF, DBA, hitting new yearly highs today. And this is a leading indicator as well, big input into our food costs. And so our food would keep going higher, unemployment at record lows, the government spending like crazy. It's kind of impossible in that scenario for inflation to come down to 2%, especially if the Fed's going to cut on top of all of that. Moving on, we've got another good bounce in China today, breaking out to multi-month highs. Clean energy right at the bottom of this support zone. International stock indices all had a good Tuesday session, with China currently looking like the strongest of the bunch. The spread of inflation expectations still holding ground above its 50-day VWAP. Semiconductor sector the strongest today, up 3%. Still pretty volatile. Weaker sectors today were gold miners and airline jets, with a bit of a breakout in consumer staples and bounce back in momentum factor. So Apple still trying to hold that support above 170. Microsoft putting in a good day, climbing back to all-time highs, and a bit of a recovery in Meta after yesterday's sell-off, but still some softness in Tesla. Other hot stocks had a good day. Supermicro up 7.6%. AMD and Taiwan Semi still holding ground, and some of the other mixed hot stocks, GE, DraftKings, CrowdStrike, Vertiv, Wingstop, and Abercrombie & Fitch all having a little bit of a bounce back today after being sold off hard this last week. More troubles for Boeing, down 4%. They've got problems all over the place. Seems to be a real shift in their brand, culture, and reputation these last couple of years compared to what they used to be. And there's a look at their biggest competitor coming out of France, Airbus. Now a larger company, 123 billion market cap, and looking at the price action, things are going A-OK for them. Got a nice pop-up in 3M today on the back of appointing a new CEO, and these regional banks still kind of just hanging in there, tracking a bit sideways, with the big guys still in a nice parabolic uptrend. Alright guys, there we are. S&P 500, 51.75. Inflation came in hot. Market shrugged it off, didn't really care. Still thinks the Fed's going to cut anyway. And I bet J Powell's really hoping they don't see any more hot CPI prints, as he's really keen to cut rates and do all his superiors a solid, not to mention keeping his job. And so in that case, the march continues higher. The market doesn't even care about hotter inflation, then what can knock this market over? We're bound to eventually get that pullback some point this year, but it might only be a 5-7% pullback before we rip into November. However, if Trump got back in office, then things could be a bit different, and maybe the Fed will raise rates after that point in time to get back on top of what looks to be an inevitable resurgence in inflation if they were to cut rates in this environment. So I'm sure there's going to be some fun and games going into November. Keep it interesting for us. As always, we'll just follow the trends, follow the technicals, and play it how it lays. Thanks very much for tuning in to the Click Capital Daily Market Review. My name's Jared, and I'll see you again tomorrow night. Cheers.